Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC. It's a terrific show today. Mark Mulholland, a terrific money manager, Matthew 25 Fund. We're going to be picking his brain. He's one of the smartest guys around, in my opinion. He's had a terrific track record. I want to remind you, a great track record has nothing to do with the future, but Mark's smart and he works hard at what he does. So welcome to the show. I think you're going to enjoy it. And without any further ado, good to see you again.
Thanks, Charlie.
Okay, so the market has been pretty good over the last few years. PEs aren't as cheap as they used to be.
Absolutely.
So now I think it's time for people to consider a discussion with a smart guy like you to figure out how do you handle a market where it's a little more difficult to pick your good stocks. So let me just start asking you some questions, and you can take as much time as you want to on these, but my first question is, does Washington matter to you? Does what's going on in Washington, D.C. have an impact on how you pick stocks and when you buy and sell?
It doesn't affect my buying or selling. It affects the economy more than the stock market. And but it's not like, even it's like, without being political, we haven't had we've had very favorable monetary policy. We haven't had very favorable fiscal policy or tax policy.
Okay.
And yet the GDP has grown, the stock market's gone up, which goes back to my argument that, you know, the president and the Senate and the House are important, but not more important than the 125 million people who get up and go to work and support, you know, and drive the economy. So the economy is going to do what it's going to do. We can have favorable things like, you know, I'm a big proponent of cutting the corporate tax rates. And that would be positive for the stock market without question, but it's I think it would be a windfall for unemployment, and especially with some of the factors that are going on in the United States right now. With you know, first of all, the quality of our unemployment is, you know, education-wise, is extremely high. Our energy boom that's coming on is really a big plus for people who want to be doing business in this country. Plus, the United States is the best place to do business. It's just that we have a 35% tax rate versus the national, you know, international average of 25.
Sure. So you could make a case that the gridlock in Washington has helped us.
I agree with that.
All right. Yeah, all right.
Yeah, I like stalemates because it's I want less intervention, and with that, we'll do well. We'll continue to, you know, the average person getting up to go to work will drive this economy.
One other interesting thing to observe is 5 or 6 years ago we had this huge problem with the banks and all that sort of thing. And now it looks like maybe the problem is shifting to student loans. You have any thoughts on that?
No, it's just one. I think it's a very political thing. I don't.
Yeah.
I'm not
So
really
they keep the
it.
rates low, and the kids take out huge loans. The colleges aren't loaning as much or granting as much. So all these kids are coming out without a job, and they're saddled with all this tremendous debt. So, you know, back in my day, if somebody took a big loan to try to head out into the world, and then they could immediately go to work. You know, I was fortunate enough to have a job every year since I was 15 years old, but I'm feeling kind of bad for some of these kids that are 26 or 27 that haven't started working yet. You know, that's probably one of the big impediments to our economy, isn't it?
Yeah, well, but you know the whole thing, like you can teach a man to fish or give him a fish.
Yeah.
Forgiving a student loan is giving a fish.
Yeah.
Doing things from the political standpoint, doing things that stimulate the economy, like lower corporate tax rates, which brings jobs, is much more important. I'm sure most students, I mean, I'm sure they wouldn't mind having their loans forgiven, but they would much rather have a high-paying job. And for the long run, that's much better.
Sure.
So.
Okay, well, outside of Wall Street, what things do matter to you? We've talked about Washington. Is there anything else you look for that tells you this is a good or a bad environment?
Well, yeah, I do. I do look at. I always look at economics, and I've said this on this program, but I say it all the time. Economics is really good to tell you where you are, where you were, but not where you're going.
Okay.
So I always do look at, and one of the things I always look at are, you can get what they call the leading indicators, coincident indicators, and lagging indicators or laggards, and all of them are positive right now. So you'd have to have a shock to the economy to change it, but that's basically we're on, you know, all systems go. Things are solid and we're progressing quite well. People focus on interest rates. I do focus on interest rates, but I'm more interested in inflation. And, you know, I have the data here, so it's probably hard to hold up onto the camera, but anyone can do it. You can if you get the weekend's Barron's, you just look at TIPS, which are Treasury Inflation Protection Securities. that has a low interest rate, but instead of getting just your principal back, you get principal plus inflation. And then you look at regular Treasury notes, the spread between those two, you could take like a 5-year Treasury note and a 5-year, and the spread between those right now, it shows you what the market's telling you inflation will be. And it's so benign. It's 2.15 to 2.2 in 5-year, 10-year, 15-year. I do check that probably at least monthly, just to make sure that inflation isn't creeping up. And I believe it'll show up there before it shows up anywhere else, before anyone forecasts and so forth.
And before the Fed acts, of course, because the Fed will be the last to do anything.
Yeah, so things are good. Well, the one problem is all this liquidity. If people always worried about it being inflationary, that's why gold was so driven up in the early years of the good favorable monetary policy. But in hindsight, I mean, Bernanke to me has been ace on. It's been wonderful.
All right, well, that's a good tip for our viewers and listeners. They can check Barron's and see what the tips are doing versus the government bond. And that's the what 10-year maturity on government bonds, or what are you looking at?
Yeah, what I always do personally, I just look at 5-year, 10-year, and 15-year.
Okay.
And then what you do is you take the interest rate, the yield on the Treasury note, and subtract the yield on the tips and
for
the spread,
that
particular maturity. You don't get them head to head, but very often you can get them within a couple months in that year. And I always do 5, 10, and 15. And I just look for see if there's any kind of slowly increasing. It's flat right now on inflation, and it's at a healthy rate. So.
All right. Are you a bottoms-up guy or a top-down guy? I've asked you about whether you look at the economy at all, but what basically do you look from the top and then go after stocks, or are you bottoms-up looking for values that people haven't discovered yet? 90%
of the time I'm bottoms up, and that's where I spend most of my day, every day. I always try to do what in research I always say there's search and research. And I probably spend 3/4 of my time doing searching, always looking for new ideas. And that's literally, I get Value Line and I go through it manually. I'll do screens once in a while, work my way up. Now I will do, so that probably covers the majority of my time. I will do some top down, and that'll be, an example would be the energy. And I think it's pretty clear that we have potential energy boom coming on. And then I'll look into a particular industry and try to figure out what are the best buys. Energy is actually particularly very hard to analyze because it's hard to create a brand like you can in some of our other stocks.
Sure.
So I have the energy holdings in my portfolio are about 7.5%, but it's really made up of 4 stocks. And so I kind of create a pool that I want to benefit what I believe in the next 10 years will be hopefully a windfall for us.
Okay, well, just out of curiosity for the viewers and listeners that have followed Value Line, do you start by eliminating all the 4s and 5s that they rate the worst, or do you look at everything, whether it's a 5 or a 1 or a 3 or whatever?
No, I mean, that screen I never do. I never look at their 4 or 5 ratings and stuff like that. Even though that's a valid rating because it's kind of like a momentum style. I don't do that because, in fact, what I try not to do is look at it subjectively. I really like Value Line just for there's a spreadsheet in the middle of the page that gives you basically 5, 10, 15-year data. Yeah. And that's what I look to see trends on sales and things like this. I'm not perfect. I will read the subjective stuff once in a while, but I try not to because I know that I always try as best I can. Yeah, it affects you. You have to. It's very hard to not be affected by things like that. So.
All right, good. Well, so what do you see as the present environment? I opened the show by saying it looked to me like things are fairly valued in the U.S., and so it's tougher to pick stocks. Is that the way you see it?
Well. Yes, we're using the analogy of a 9-inning game. We're in the 5th inning.
All right.
Now I don't, we've had basically 5-year bull market, and I don't know. I'm not saying it's 5th inning. It's only 4 more years ago. It could be a year and a half to 12 years. I don't really know. Just like baseball, you don't really know how long the innings will last time-wise. Where we are right now is, even up to about 3 years ago, everything was below private value.
Yeah.
I would say majority of stocks are below private value, but just slightly now. A good example is, one of the things I always do is another trick, is every merger I'll look at because I want to see what knowledgeable buyers are paying for companies. A fairly recent one without dating the program was Hillshire Brands. And which was very interesting that they were trying to be the buyer and became the buyee.
Yeah.
But they're paying about 13 times EBITDA. Now I think that's rich. And and to give you an example, earlier there was an acquisition by Berkshire buying Heinz, and he wouldn't go above 12. He got up to 11.8 and stuff like this. I think 10 to 12 is kind of like my normal range of fair times EBITDA.
Yeah.
You can still find companies below it. There are companies above it. The difference is you're not getting as hardcore value, but you are now getting growth and momentum. And it's beginning, so in one sense, the market's always hard. You were getting cheaper things 3-5 years ago, but nobody wanted to buy into the market, and it took a lot of courage. Now I think you don't need as much courage, but it's a little bit more selective. You have to do a little more homework.
Fair enough. Before we get into any specific stocks, I want to remind our viewers and listeners that they should be consulting with their own advisor. We're not tax experts. We're not accountants, and they should be getting that kind of advice from somebody else.
No question.
And although you've got a terrific track record, there's no guarantee it will continue.
No, it's
now that we've gotten that out of the way, let's take a question. We have a question from Richard Dean of Ardmore. What are the next big growth stocks or sectors? Answer that any way you want to, Mark.
Okay. I think what he might be asking is not so much growth, because if you want to get growth, you could just look at, go through Investor Business Daily and look at their they'll rank, stocks on growth.
Sure.
What he really, I assume, he's asking is where am I going to make the most money in the next few years? Mm-hmm. And there's a couple of stocks. So really, it's not growth of the business per se; it's growth of their capital. I would say look very hard at financial stocks. One of our holdings is Goldman Sachs, and I mean I could be wrong. Obviously, more often than not. But if I look through the portfolio now, I look at Goldman as having one of the highest upsides. Okay. And the reason for that is not that they're a growth stock per se. They'll grow decently, just with the economy 7 or 8%, but it's their business. And they're not pushing it at all. I mean, at the peak, I'm reading, in fact, the book. I can't believe Geithner's book. Okay. And he was talking about at the peak, the financial stocks like Morgan Stanley's, the Lehman's before they went under, and Goldman were probably like 30 times leverage. They were, for every dollar of equity, they were holding $30 in assets. They're probably closer to 11 right now.
Yeah.
I mean, they're not pushing the companies at all, and yet they're still cheap. They're selling close to book value. They're basically 10 times earnings. So what you'll get on something like this, and you can see it like in Goldman in particular, insiders have been taking almost all their bonuses in stock the last 3 years. As this economy gets stronger, and you can see it with M&A activity and other things, they'll start pushing it. And this company, their earnings, I think, can easily double in the next 4 years, and can easily go from 10 times earnings to 12 times or 14 times earnings. And that's where you can get, that's where you get growth of money. You can get I think easily you can get 3 times your money if everything goes reasonably well.
All right. Well, before we delve further into that, thanks for that answer. If you have a question, please send it in to Money Matters, 205 East Levering Mill Road, Bala Cynwyd, Pennsylvania, 19004, or email us at moneymatterstv@gmail.com. Okay, so let's take the specific one you were discussing. Let me play devil's advocate for a second. Okay, so there's some people that are saying, well, it's different now because the banks were playing games with the whole world and they almost caused the world to crumble, and so now the regulations have come in and the Fed is going to be watching, and they're not going to let banks get into heavy trading and leverage, and if something goes wrong they can fail, so therefore they'll be more cautious, and some of the banks are starting to get rid of some of their traders and that type of thing. So your feeling is Goldman Sachs is a little different than a typical bank, or even within the leverage they're allowed to use now, they can do well? Well,
they are, but like we also in JP Morgan, which would be more of a typical bank or hybrid, always in the market, one of the things probably more important than just say, give me growth, is take advantage of the pendulum. And yes, they were pushing it probably too far before, and they put a lot of legislation in, and because of that, the pendulum's gone all the way over here. So they're running the companies incredibly conservative.
Yeah.
All of them are buying back stock. They're taking stock on the inside. They're not dumb, And what will happen is, will they get to 30 times leverage? No. But if they go from 11 to 21, which will still be well within the parameters, you have the ability to double. That alone can almost double your earnings. Plus, I would say greater than double potential because of, there's, you don't have to double your workforce to do something like that. So it's one of the things that you have to, they're not going to disappear. They're still very, very important to our society. There's also a supply-demand factor. I mean, you really had, Merrill Lynch is still here, but it's part of, Bank of America, which I don't think they're going to be as strong. Mm-hmm. Bear Stearns is part of JP Morgan, so that's really just consolidation because JP Morgan was in that business. Lehman Brothers is gone. So really you had 5 big players. You really have 2.5 to 3 now.
Okay.
And the business is going to be the same at some point. So, I mean, you hate to see what the process we had to go through to get that, but you have to learn to move on. And it's not what happened in the past, it's what's going to happen in the future. And Goldman, which is it happens to be one of my favorites, is I mean, think of it. We went through, without question, if not the worst, the second worst, at minimum, the third worst financial crisis in 100 years. Goldman earned money in every single quarter except one, the year in of '08, where they actually did just a write-off of assets, no cash outlay. They not only survived it, they went through that wonderfully. Yeah. So you would think you'd pay a premium for that. You're getting that company at 10 times earnings with a 12 to 15% return on equity, which can easily get pushed up to 18 to 20%, and close to book value. It's worth way more than book value. So, I don't know when it'll happen. I've been bullish on Goldman, and it's been done fine, but not great. It's the same type of thing. I'm looking through the portfolio now and saying, okay, Goldman didn't do as well as I thought it would have 2 or 3 years ago. Some other stocks did better. What's going to make the most money going forward? And I would look at it and say Goldman has the most potential, has everything that makes sense to me. So.
All right, good. Well, great answer. I want to remind our viewers and listeners, don't run out and buy a stock because Mark said so, because he watches this stuff every day. You know how to drill down and keep a watch on him, and I don't want somebody buying something and then not paying any attention to it. They should be using an expert like you or getting advice from an expert.
The advantage of dealing with a broker, if someone that you trust and you know is good, is they're doing the work for you. The advantage of using a mutual fund, in my particular case, I'm a shareholder, along with all our other shareholders.
You eat your own cooking.
Yeah, I'm not the biggest, but I'm one of the biggest shareholders, and and I'm managing it. It's really, and so what you're trying to do is, live your life, do what you're good at, and then turn your money over to someone else and let them go. Because I do think, the story on Goldman can change in 2 years. I don't think it will, but it could, and it may not be all positive. It could be negative, and that's, I'll manage that as best I can.
All right. Well, I took a look at some of your biggest holdings, and I just wanted to try to pick out a couple that maybe can help educate clients by answering a couple of questions. Let's talk about Brandywine Realty, BDN.
Good one.
When somebody tries to go in and look at that, they'll say, gee, there's no PE, or it's some huge PE or something. And of course, there's other things that matter in a realty stock. So explain how you look at a stock like that differently than when people are just trying to look at PEs and see how some growth stock is doing.
Okay, well, Brandywine's a good pick because Brandywine's a local REIT.
Right.
And the reason I went into that was a couple years ago, we have some appreciation in it, but I can tell you I've bought Brandywine very, very recently. I still like it. There's 2 ways to look at Brandywine. This one's a little harder, but I do this. You add up all the debt, all the preferreds, market value of all the common stock, and divide that, put that over its cash flow, or do it like what they call cap rate. Take that cash flow and divide it over it. Brandywine, even now, is selling for what you would have to pay for a building. Probably even a little bit cheaper than what you'd have to pay for a building, by itself. You're getting Brandywine's management. Another good example, Eat Your Own Cooking. The guy who runs it, Jerry Sweeney, is a great real estate manager. It's public. He has about $20 million of his own money in the stock. He's going to run it for the benefit of shareholders, both from a fiduciary responsibility and from a pure economic situation. And they're doing good things. Like they're right now, you're not seeing. Well, there's a couple things on that I'll say. You don't see great growth in earnings, and the thing that will drive Brandywine is when they start raising their dividend. I don't expect that right away because they're building a new Siri building. They've made some great acquisitions downtown in Philadelphia. They have some great acquisitions in Texas where they're expanding a bit. They sell some of their flagship type of properties, but they're right now, because of 2 or 3 construction projects, that's where most of their cash flow is going. But eventually, these buildings are going to rent. They completed the post office conversion down there, which is the IRS offices. They're going to get great cash flow out of this. Real estate's cheap. You could still get this particular stock. Another way to value it is book value is around 12, so it looks like it's a little bit above book value. But you can actually look at cost bases of all their properties, and these are properties going back that they've owned since the 80s. Some of them, and a lot of them early 90s, late 90s, way before the peak. All you had to do is take basically the book value and add back depreciation, and it gives you kind of like they're close to their cost bases. That's about $18 a share. So this thing's selling below what they paid for all their properties over the last 25 years. And I think commercial real estate's cheap. I think it's one of the areas you can make money. The other thing on it too, there was an article that just came out from Wall Street Journal and said, now I wouldn't stay this long, but the average, you can see they put out the number called FFO, which is funds from operations, which is kind of cash flow on a per share basis, not including the debt. The average is 17 times, which to me seems very, very high. They're about $1.35 to $1.40 in the stocks. You're about 11 at the most times. Wow. So this stock is selling for about, you get into intrinsic value, which I think is good, relative value, which is very, very good. I have no idea why. It's been that way for a long time.
Yeah.
It's not in value line. It's not one of the things you'd find that the average person find, but it is a local company and it's very well run. It's got some great properties. So I believe we'll make a lot of money from that. Not as much as some of the others, but
all right. Well, excellent insight. Thank you for that. Now, I decided to pick a couple of stocks that have high PEs. Scripps Network and Polaris have about a 20 PE. Now, in general, when we hear that the market's at 16, and it used to be at 10, and the tendency for somebody just scanning through would say, "Oh, I missed that one." Well, why do you like those two stocks that are?
Yeah, it's funny. I'm not great on PE. I'm better on EBITDA. That's how I look at things. Right. And Scripps right now is 10 times 2014 EBITDA, right, which is and completely unleveraged, no debt. Actually has a net slight positive cash if you take the working capital and subtract the debt level, and they're probably at least a 10 to 12% grower. They own some great programming, HGTV,
cooking shows.
The food program. There's a whole. They have. I can tell you in our family, that's the go-to channel. If I turn the TV on, between my wife and my oldest daughter, it is. It's almost always on that channel.
You have to switch from there to Fox.
I have to go with something else or CNBC or something like that.
CNBC, all right. Fair.
But they're. I do like Fox. But they were. But the thing is, so you have a solid. And remember too, like the big thing, like look at what Comcast wants, is you want content. Content's of value. So you get unleveraged, 10 times EBITDA cash flow in this. Right. It was up in the, it's in the mid-70s now. I still buy it, actually. It was up in the 80s when there was some rumor of a merger or takeover. Mm-hmm. And I think it'll come eventually. There's not, the Scripps family trust, all that stock's getting disseminated. It's going to lose that central authority. It's sometimes the hindrance like Hershey and stuff like this. But we'll make good money on this. This is what I consider a growth and value stock.
But you don't buy a stock on a takeover story. That's just a bonus if it comes.
No, it's always a bonus. Anyone who does it in anticipation,
it's a mistake.
It's just hard. But but you get them. A couple years ago, we had 3 takeovers in 1 year.
Sure. All right. Well, let's. Polaris probably a deep story like that also. But let's move on. You mentioned Goldman's favorite stock. Have you got any other ideas that really float your boat that you want to throw out there?
Yeah, in fact, you could see it by our size of our holding. Our biggest holding, Apple. Apple is still a value growth play. Okay. And, I don't know why there was this, it gets a lot of hype and people were really, like I even watched Kramer on the show one time. He was telling, when Apple was declining, it lost its cool. And then my wife even laughed when I told him. I watched the program the other day and he said, he goes, they got their mojo back. Apple, the story of Apple has not changed anywhere near as much as the price has. It's still one of our cheaper stocks. It's still going to be at minimum a 10 to 12% grower, just purely from the continued expansion of handheld devices. And they don't have to be number 1. They can be number 2. I don't care. They make a great product, and they will be a major player in it. Another good holding, our second biggest holding, is Cabela's. And Cabela's was a real hardcore value play down cycle in the market. But where they are now, they're opening stores at a minimum 15% clip. In fact, I just went to their opening in Christiana Mall. And I mean, you're looking at, I got there a little early because we were they did a tour with like the analysts and owners and stuff like this. But there had to be 250 people in line 2 hours before the opening of the store. Wow. I mean, it's a great brand for a retailer. It's really hard for a retailer to be a brand. Same thing. What are you paying for that? 8.25 times EBITDA. It's cheap.
Yeah. Okay, let's do one other. You mentioned that you have one ADR. How did you come upon that? An ADR, of course, American Depository Receipt, which is an overseas stock.
Yeah, it's if I do anything foreign, almost every time, I did one time, almost always are going to be ADRs. You get a little better reporting than you do on just an international stock that trades over here. It's in fact, they even find like their annual, quarterlies and 10Ks are very difficult. It all falls under this Form 20F. But I was a couple years back when Europe had their crisis. It's like anything. It's when you talk about top down. That's what I call my vulture investing. Whenever there's a lot of bad news, you want to kind of like circle and look around. I was looking in Europe. The banks looked appealing to me, but not as cheap as American banks with a lot less headaches. And Telefónica España was, I felt, the cheapest. They had cut their dividend, during that crisis, and yet their earnings were still good. Even now, it's probably about 6.5 times EBITDA. It's got a great business, and 2/3 of their business are outside of Europe. And they're also an income play. One of the things that drives stocks is either, besides growth, is income, increased income. And if they get their dividend back or 2/3 of where it was a couple years ago, the stock I believe will go much higher.
All right, terrific. One other one, when I looked through your holdings that kind of interested me because of its past history, is KKR. There's some stories of buyout stories, and they've been doing this stuff for a long time. Any comments on that stock?
Yeah, it's actually, I hesitate to plug it too much. We own it. I love it. It's a nice income. It's going to grow. The way they went public made a ton of sense to me. It wasn't just a dumping at the peak. In fact, they acquired something cheap, which that's what we did. We had owned their, they actually had a publicly traded partnership, and they, it was below book value. But they're hard to analyze, so I don't want to plug, but I actually believe if this economy stays the way it is and they keep doing the M&A business, it'll be one that we can make a lot of money from.
Fair enough. All right, well, I've been asking you a lot of questions. Anything you want to talk to me about?
Yeah, I always find you interesting for what you did personally on real estate.
All right.
And how, like, using that same analogy where we are in the market, I said I believe we're in the fifth inning. Where do you see us in the real estate cycle?
Well, I feel that way. As you and I both bought homes when this downturn created an opportunity. And speaking personally, we love the home we bought. We bought it for a very, very reasonable price. We're going to enjoy living in it, and I don't care what the price is tomorrow or next month or a year from now. When I can't get up the stairs anymore to get to the bedroom, maybe 10 years from now or whatever, I suspect that I'll be able to make a few bucks on it if we need to leave. Otherwise, I guess we'll put an elevator in it or something and we'll stay there.
Stay longer. Sure.
Yeah, but we love that place. And in general, with real estate, of course, the question is whether we had, just like the economy, did we have a little bit of a funk over the last few months because of weather, and now will things start to come back? I'm concerned about how difficult it is for some people to get a loan and that type of thing. I think there's a lot of artificial factors that are preventing the real estate market from climbing right now for the moment. And we've got elections coming up. We've got all sorts of things happening. So it's murky for me over the next couple of years. But I feel like if somebody has been renting and they think there's a home that they're in love with, and they say, I missed the 3 5/8 mortgage, I'd have to pay 4 1/8 right now, I'd say go out and get that house and get that mortgage and enjoy living in it, and don't worry about when the price is going to go up. You'll be okay. What's your thought?
I think we're in the second inning of real estate. It's a lot to come, and I think the two items that are going to make the most money for people over the next 5 to 7 years will be real estate and stocks.
All right, good. Well, I got one more minute if you want to ask me a question.
International.
Okay, well, I think international, there's a lot of stocks over there that are cheaper than U.S. stocks.
Okay.
So I'm starting to look over there a little bit, and I'm not smart enough to know which stocks, so I'm trying to hire smart managers with part of our money to get out of some things that are overvalued in the U.S. and move that money to emerging markets or to international. I'm not going long on bonds right now. Overseas, there might be some places where you can get a little bit of income more safely. So in general, I think we all have to have a worldview now, and we can't just think U.S.
Okay, great.
Well, I really appreciate your expertise, Mark. It's so nice of you to come in and share it with us. You're a great guy. You're a smart guy, and I wish you well in your future endeavors. Our guest next week, Paul Sloat, is going to join me, and I'll be able to pick his brain. He's another really smart guy. He's more value-oriented instead of growth. So we hope you'll join us next week. As far as we're concerned, your money matters.
Thanks, John.